Hey there and welcome. My name is Jake Adams, and today we're going to be talking about the 14-day Augusta rule. Now, this is Tax Savings Team. This is for tax professionals, CPAs, enrolled agents that are looking to grow their business through offering additional value, more value to their clients, and increase their profits. So today we're going to be talking about the 14-day Augusta rule and how we can add additional cash to both your practice and to your clients' bank accounts. So let's talk about a little bit about the 14-day Augusta rule and what it is. So basically what the 14-day Augusta rule is nicknamed the Augusta rule because of Augusta, Georgia, and the Nationals golf tournament. And what would happen is there wasn't enough hotel rooms in Augusta, Georgia, so people would have to rent out their homes to the people that wanted to travel and watch the Augusta Nationals golf tournament. So what would happen is someone said, hey, is there any way that I can rent my house, tax-free? Is there any way I can get a tax benefit for it? And somehow, some way, something got put into the tax code about being able to rent your primary residence for 14 days. Now, typically what this would be used for is maybe an Airbnb or somebody that wants to rent out their home for 2 weeks and not pay cash on it. But what we're going to do is kind of change it around a little bit, where we're going to rent the home to the S corporation. And because it's two separate entities, we're able to do that without any problems or conflicts with the tax code. Now, if you have a single member LLC or it's a sole proprietorship, this will not work because there's not two separate entities. We need a separate entity like an S corporation or a C corporation. I shouldn't say S because S is a tax election. So it should be a separate corporation so that we can truly get a separate business entity for this, that the tax code is actually, or the taxpayer is actually renting their home to a separate business or separate entity like their corporation. So how does this work? So essentially what we're going to do is the 14 days, the best way to do it is having a monthly meeting. So if you have a monthly meeting, that gives you 12 times per year that you can use the Augusta strategy. So essentially what we're going to do then is say, well, every business needs or should have a monthly meeting. So what's involved in that monthly meeting? Well, things like the minutes, things like, should we open a bank account? What's our profits look like? What's our marketing strategy? What clients do we have now versus what clients did we have last month? What clients do we expect next month? What's our marketing strategy for next month? What does our marketing strategy look like for this month compared to last month? So there's lots of different things we can kind of cover in a monthly meeting, and we just need a space to have that meeting. So the space to have that meeting can be inside our own home versus having to rent a conference room, right? So essentially how the 14-day rental rule works is that we go out and we get comparable pricing, market pricing for a conference room. So that's step one, is we need to figure out, do we need a conference room? And yes, we do need a conference room because we need to have monthly meetings. So once we're going to have these monthly meetings, what's the comparable rate for a conference room? So first step one is you need to get conference room rates. So once you've got the rates for these conference rooms, they're going to go anywhere from $500 to about $1,000. And the conference room rates is, and you can go to a country club, you can get something really nice for, $600, $700, $800, $900, $1,000. You can go to a country club, you can go to a Hilton, a Hyatt, a Marriott, whatever you feel comfortable as far as getting a conference room. It can be for 2 people, it can be for 4 people, it could be for 8 people, however many people that you could have at your monthly meeting. Now, essentially what's happening is so then we're going to choose where we're going to have this meeting. So we've already got the conference room rates. Let's say you got one from a country club and one from a Hilton, one for a Hyatt, and then you also have your own home. And then you can say, okay, if we look at the spread of prices, right? Let's say the spread of prices is between $500 and $1,000. So let's say, okay, let's do the average about $750. So that way you can say, okay, instead of going to the Hilton or Hyatt or a country club, we're going to use our own home and rent our own home to a corporation to have their monthly meeting for, let's say, $750. Actually, let's round up so the numbers are easier. Let's round it up to $1,000. So if we do $1,000, again, this is more on the aggressive side. $500 is more on the conservative side. But essentially, what that will allow us to do up to 14 days at $1,000 gives us $14,000 completely tax-free. Now, if you're at a let's say even a 20% tax bracket, so 20% of 14,000, or let's say a 25% tax bracket times 25%. What does that give us? $3,500 in tax savings just on the federal side, not even on the California side or on the state side. So $3,500 of true tax savings. Now, this is literally just taking money from one pocket and putting it to the other. So the 14-day Augusta rule, you do that 14 times, $1,400, $3,500. Again, that's on the more aggressive side. On the more conservative side, let's say you even take half of this, right? So you're at like $1,750, right? So $1,750 is still really good in tax savings. And all you have to do is have a monthly meeting, which you probably should anyway, right? So let's take this out of context. So this is how we're going to talk to our clients about it. But why is this good for you? Well, when you're talking about the 14-day Augusta rule, again, it's one of the core four. And one of the core four is true tax savings. Is money that you're taking from one pocket and putting into the other. There's really no deferrals. It's not accelerating your depreciation. It's not accelerating tax savings or anything like that. This is true dollar for dollar tax savings, taking it from one pocket and putting it to the other. So when you're doing this and you're actually saving your clients $3,500 a year, this is true tax savings that you need to be able to put a tangible value to it, right? So when I'm talking with potential clients about working with me, and I say, hey, I can guarantee that I'm going to save you, well, I usually don't say I'm going to guarantee that I'm going to save you X. But when I say, okay, my minimum monthly fee is $300, or my minimum yearly fee is $3,600, and I guarantee that I can find at least that in tax savings, boom, there it is, right? Just with one strategy, I know that I'm going to be able to find them at least $3,500. And that's just with one strategy, right? There's lots of many other strategies. So the cool thing about this and the benefit to you is that when this will allow you to elevate your level of expertise and elevate your level of value that you can provide to your clients. Because like I said, with just this one strategy, we're finding over $3,000 of tax savings. So what you need to be doing, and what you need to use this and shift your focus and shift your context you're thinking of is, okay, I am a tax strategist. I'm not just a tax preparer. I'm actually a tax strategist, right? Knowing this is going to save your clients $3,000. Now, what would your client expect to pay you to save them $3,000? Now, I'm not talking about, I'm going to save you this, so you pay me this. This is about the value that you provide as a tax strategist to your clients. So I want you to stop for a second and think about the value that you're providing through this and through the S Corporation, some of the other strategies that we're going to be talking about later on this week, and put yourself in the context and think about it as the value that you're adding to your clients. And if you just do the tax return for $300 or $400, $500, and you just say, okay, well, I'm going to add the tax strategy in there for free, and you're not putting a quantifiable number to this, is that really helping you? Is it really helping your firm? Is it helping you grow your profits in the way that you really want to be? Is it allowing you to work with fewer clients in a more value-based scenario? And is it allowing the clients to really get the full amount of value working with you? And the answer is totally up to you, right? But what I want to do is kind of push you out of your comfort zone a little bit and challenge you and saying, are you really charging what your value and what your expertise is worth, right? There's a lot of time that we as CPAs, as tax professionals, enrolled agents, there's a lot of time that we spend learning about the new tax code law or learning about tax codes and putting stuff like this into practice. So this is my challenge for the tax savings team, is to challenge you to think outside the box and say, okay, is there a quantifiable dollar figure that I can feel comfortable, that you can feel comfortable charging your clients for this additional strategy and not just giving it away, right? Because yeah, it's easy. I mean, I just talked about this in 5 minutes. So it's easy to say, yeah, let me just give this away, but don't, right? Don't just give this away, because your clients see a lot of value in this. Your clients see a lot of value in implementing this. And that's really what the tax strategy team is all about, is giving you the confidence and giving you the tools and implementation guides and everything that you need to be able to really talk to your clients about tax strategy, about these tax savings, and about growing the practice that you deserve, growing the dream practice that you want to have, the clients that you want to work with, the strategies that you want to implement, and having the clients that see the value in working with you when we're talking about tax strategies like this. So thank you so much for joining me. This was a quick video on the 14-day Augusta rule. Tomorrow we're going to be talking about the health reimbursement arrangement, or the MERP, the Section 105, which allows you to pay for out-of-pocket medical expenses completely tax deductible. So if you like this, please give me a thumbs up, give it a like, put any comments you have down on the bottom of the video, and I'd be more than happy to jump on those. We actually have a couple comments here, so let me read these over really quick. All right, cool. So we've got a quick question on the 14-day Augusta rule. As far as a single member LLC, is this okay for a single member LLC? It is, and it's not. So the problem is the more paperwork and the more the entity creation that we have for the 14-day Augusta rule, the better that we're going to come out under audit, right? Of course, knock on wood, you don't get an audit, but if you do, the more things you're going to want to have the documentation. So part of the documentation is having the entities set up, and also having your conference room rental rates, having some sort of invoices or proposal from a meeting facility like a Hilton or a Hyatt, even a Holiday Inn or a country club. You're going to want to have that documentation. And then also documenting that you actually paid this, right? It shouldn't go the same way that your payroll goes through, and it shouldn't go through the same way as your dividends. So you can't say, oh, I paid myself $5,000 in dividends, as $500 was rent. No, you would want to have a separate check, and you would want to have a separate invoice for that amount. So it's very important to keep your T's crossed and your I's dotted when we're talking about documentation for any sort of tax strategy. All right, so that's going to wrap up for the 14-day Augusta rule. Thank you so much, and keep tuning in for more tax savings tips with the tax savings team. Thanks.